All right, what is a bypass trust? A lot of people haven't had a need to concern themselves with that lately just because the estate tax is so high, the estate tax exemption, I should say. So very few people are paying the federal estate tax. And on top of that, the federal government has a portability provision, which means you don't have to bypass the surviving spouse. But some individual states, Connecticut jumps to mind, which I just talked about earlier today, does not have portability. And so their estate tax exemption is only $5 million. So what happens here is a lot of people, and the people say, oh, no one's paying the estate tax. It's $5 million, just way more than average. Man, it's real estate owners, dudes. It's farmers. It's people got big buildings that they're housing businesses. These are the people who get suckered into paying the estate tax, man. This is nuts to me. Where does the cash come from to pay a $500,000 estate tax? They got to liquidate the property. They liquidated a fire sale, order a commercial realtor because they're going to put houses on there. Just the whole thing's nuts. So what happens is in Connecticut, instead of having to liquidate the property or leave it to your kids, you say I'm going to put it into a land trust. So that way it's not subject to estate tax, but you're also not getting any net value out of it. It sounds good in theory, but look at Connecticut. There's all kinds of land trusts. It's nuts. The whole thing, you got a farmer, you're a farmer. You're like a $10 million piece of land outside of Hartford. We'll just use that for example. And when you started the land, it passed generation. Now it's appraised at $10 million. You got $100,000 in sitting in cash. That's it. Because most farmers don't have a lot of cash. They're land rich, cash poor. And all of a sudden you die, and now your estate says, well, we have to pay $500,000 of estate tax. The only thing we have is dad had a farm that passed down generation to generation to generation. We have no other way to pay it, so we're going to have to sell it to freaking commercial realtors, and then everybody's worse off. That's why the family farm is one of the reasons they're going away, by the way. All right, so in this case, we got a $10 million estate tax, a $10 million estate. It matters not what it is. We have joint. So it's Josh and Charlotte joint. All right, so you have $10 million estate. So I die, and $5 million, we'll just say I have $5 million. I die. I leave my $5 million at Charlotte. So Charlotte has $10 million. Does that make sense? Now in Connecticut, when she dies, $5 million is not subject to estate tax, as free and clear, all right, from estate tax. But other $5 million is subject to estate tax. All right, so that's what happens. So I die, I leave my proceeds to Charlotte. Literally, this is what happens. So basically, you can even go like this. Charlotte's got $5 million, I got $5 million. We combine it and eat it right there. That's what happens. It's called I love you wills, or I love you, I love you will. Josh got $5 million, Charlotte's got $5 million. Josh dies, it all goes to Charlotte. She has $10 million. When she dies, $5 million goes to kids free and clear of estate tax. The other $5 million goes subject to federal estate, it could be federal estate, not now, but Connecticut estate tax. All right, so what we want to do instead, and this is where something called equalization of estates is so important. So let me show you, and again, I haven't had to use this much lately. I used it a lot back in the late aughts and early teens, but haven't had to use it much lately. So got to I'm rusty on that. I'm in spring training. So an equalization of estates is actually quite simple. We have a $10 million estate. Josh has $5 million. Charlotte's got $5 million. All right. So what happens is we want this $10 million, estate. We want to go to the kids. That's our goal. So I die. My $5 million goes to the kids. Charlotte's $5 million goes to the kids. The kids end up with the entirety of $10 million. If that makes sense, because both of us have an estate exemption. We both have $5 million. Any single person in Connecticut has a $5 million exemption. And that's called equalization of estates. Now, this is very simple in theory, but it's not very simple in reality because most people have 401ks and whatnot. But essentially, again, here we're splitting our estate. Charlotte's got $5 million, I got $5 million. At the death of me, it goes directly to the kids. At the death of her, it goes directly to the kids. Ultimately, the kids end up with $10 million, no subject to estate tax whatsoever. But the problem is, now Charlotte's only got $5 million. And so my estate just bypassed her. And this is not a bypass trust. It went directly to the kids. It went directly to you. It went directly to anybody. So it's passing free and clear from Connecticut estate tax, but it's avoiding my wife. She has no access to this. That's not what we want. So we want a bypass trust. Now, bypass trust is simply going to say, all right, well, I want the trust to the assets to bypass Charlotte. All right, so I don't want her to have access to take ownership of the money. I want it to bypass her estate. So what we're going to do is we're going to say, let's draw this a little bit differently. I totally forgot how I used to draw this up. I'm not drawing up as well as I used to. We have a $10 million estate, of which is 5 is me, and the 5 is Shar. Josh Shar. All right, so again, if I leave my $5 million to her, that's going to be equals $10 million. Not good. We don't want that. We don't want that to happen. So I want to bypass her estate. So I'm going to create this bypass trust, $5 million. They call it AB. Is that I think that's a B trust, I think is what it's called. If memory serves. You got A, marital, B is bypass, and C is Q-tip. Yeah, I think it's a B trust, a bypass trust. You got a marital trust, a bypass trust, and a Q-tip trust. And to be honest, it's been so long since I've had these discussions, I can't remember exactly what the Q-tip trust is. I remember the Q-tip does go back in her estate, where the bypass trust does. The bypass trust literally bypasses her estate. All right, so what happens though is, it's bypassing her estate. So at Charlotte's death, again, the $10 million goes to the kids. No estate tax at all, none. So my money doesn't go to her, instead goes to this bypass trust. Her money stays in her, and when she dies, this bypass trust goes to the estate, the kids, and her money goes to the kids as well. In the interim, see, I'm not making it not a line. It's like see what I'm saying? She has access to this money for health, education, maintenance, and support. HEMS. That's an M. Health, education, maintenance, and support. So she is not the trustee. All right, so the trustee is running this. This is why the trustee is so important. It's not Charlotte. It's not Charlotte as a trustee, somebody else. Uncle Bob. All right, Uncle Bob's the trustee. That sounds good in theory, but Uncle Bob's 25 years older than Charlotte, and he's got Alzheimer's, and he likes the New York Yankees. Don't want Uncle Bob to be the trustee. So you want to make sure we got our trustee knows what the heck they're doing. Might be your local attorney, might be a bank. You have a bank trustee, or it could just be your son. It doesn't matter, or your daughter. But we want someone to be the trustee who is not her. We do not want her to be the trustee, because if she's a trustee, essentially she has ownership stake in the property, which means it'll be subject to estate tax. It'll go back to her estate. Always remember, if you're the trustee, it's included in your estate. That's all there is to it. So we do not want Charlotte to be the trustee. And the trustee is just a person who literally handles the day-to-day activities of the trust. So in this case, the bypass trust is going to be run by, we'll say her brother Bill. All right, so Bill is running the trust. Bill is saying, okay, I'm going to give you HEMS, health, education, maintenance, support. That might be $50,000 a year. That's going to come out from this trust. It's going to go to you on a regular basis. Whatever the residual at your death is going to go to the kids. It might not be $5 million, it might be $4 million, it might be $6 million. We don't know. Whatever the residual of that trust is going to go to your kids. All right, so your kids will get, could be 10, could be 9, could be 11. We don't know what it's going to be, but we know for a fact you have your own money, and we got this money right here. Now, what we want to do is, if you're the beneficiary of a bypass trust, in this case, Charlotte is literally the beneficiary of the bypass trust, we want to spend your money as quick as we can. All right, we do not want to spend the bypass trust money, because your money we want to get out of your estate. And I don't want to get too deep in that here today, but the best way to reduce your estate is to give up money or spend it, for sure. So in this case, we want Charlotte to spend as much as she can. I mean, doesn't want to go crazy, to reduce her estate. If her estate goes above $5 million, we want it reduced, because this has already been subject to estate tax. It's already passed the estate tax threshold. So we want that sucker to grow. We want that sucker to be reduced by income, for sure, or distributions, or anything that comes from estate planning. I know there's a lot going on here, but this is a bypass trust. So she has access to health, education, maintenance, support. And frankly, she should take that, because whatever's retained in this trust is taxed at significant highest tax income. I think the trust had $5 million and it was getting paid a 4% dividend yield. That's $200,000 a year. Was the highest tax bracket is like $13,000. So basically, in a trust, a debt retained income is taxed at the highest tax bracket. I think it's $13,000 is the highest tax. If for any trust that retains $13,000, they're paying the highest tax bracket, 37% plus a net investment income tax is crazy. So we want this money, we want her to get the health education maintenance support to come to her for sure. We don't want it retained in the trust. But with that said, we also got to be careful on the trust, what the money she has as well, to make sure she doesn't have this sucker grow and grow and grow till when she dies is $8 million. That's not going to work, because then $3 million, that'd be subject to estate tax. A lot going on there. I get it, but it's good to know what a bypass trust is. Just remember, a bypass trust. I'm bypassing going directly to Charlotte. I'm bypassing her estate. So I'm taking a detour. Instead of going directly to Charlotte, I'm taking a detour here, which means she has access to some of the pros, some of the income. No, not just the income. She certainly has income. She has access to some of the principal. But upon death, her estate plus the bypass trust estate essentially is combined going to the kids estate tax free, depending on what the value is on hers. Hope that makes sense. A lot going on there, but man, it's so important if you live in one of these states. Is there portability in Massachusetts? Frankly, I don't know off the top of my head. The issue on portability would say that she could file. I'll get into it real quick. If it's a federal government, you don't need a bypass trust really anymore. And I hate to say what a lawyer will tell you. I don't know. But generally speaking, a bypass trust literally bypass your estate, so that way you both are taking advantage of your exemptions, your estate tax exemptions. With a portability, you really don't need to do that anymore, because what is my unused estate tax exemption, I just filed some form, I forgot what it is, in the feds, and that adds to Charlotte. So Charlotte, if I didn't use $2 million of my $5 million exemption, and Charlotte then has $7 million, yeah, her 5 plus a 2 I did not use. That's portability, if that makes sense. In Connecticut, you don't have that. In the federal government, you do. So the federal government, we don't really need to get too deep in bypass trusts and whatnot. It's fun. Estate planning is fun, man. I've always enjoyed that immensely. There's not that many good estate planning attorneys. I know that for a fact. And when I say good, it doesn't mean they're bad. It just means there's not that many. And because of that, I'll talk about this in my seminar for financial advisors on Tuesday who want to be financial advisors. Man, if you can make headway with an estate planning attorney, man, you'll serve your clients really, really well. It behooves you to understand estate planning, that's for sure. And you don't have to practice law to do it, because you don't. I mean, I'm not practicing law. I'm just telling you what a bypass trust is. I don't draw it up. I don't say if you should do it or not. I have no clue. And each state's different, of course. But man, if you can learn estate planning, just basic stuff. That book, Vicky Schumacher, Understanding Living Trust. I put that, I think it's in my show notes actually. So if you look on my show notes, you can see my Amazon link. I'll put that on there again. But if you can just have some basic knowledge of estate planning, oh man, you can really make headway with people who need to know this stuff. Lastly, just remember, your trustee is such a big deal. You got to know who the trustee is. It's called a successor trustee, frankly. So you are the trustee. I'm the trustee while I'm alive. At my death, I'm naming, Brother Bill. My brother's name Ben. I'm naming Ben as my successor trustee. He's going to step up to the plate at my death to manage the trust. Hope this helps. Love to hear your comments. Thanks now.